Silver didn't become a headline by accident. It became one because a bold prediction collided with a market that was already under pressure. When Robert Kiyosaki talks about silver reaching $200, people listen, not because he's always right, but because his words arrive at moments when emotions are already elevated. Right now, silver is exactly in that emotional zone. But here's what almost no one is discussing. That prediction itself may not be the confirmation of a clean breakout. It may be the trigger for what comes next. Not the move everyone expects, but the reset no one is prepared for. Markets don't move in straight lines when expectations become crowded, and silver has never forgiven investors who mistake a destination for a timeline. Before positioning yourself based on a number, you need to understand what silver does before it ever gets there. Welcome to Boring Currency. I know the name doesn't exactly scream excitement, but neither does watching your portfolio bleed because you misunderstood what the market was actually telling you. If you remember a time when financial analysis meant something before everything became noise, then you stir in the right place. We don't do hype here. We do structure. We do clarity. We focus on warning signals that matter. If that resonates with you, subscribe. Not because I need the number, but because when silver moves fast, and it will, you all want to understand what is happening before the crowd figures it out. And leave a comment telling me where you're watching from. Market behavior changes by region, and perspective matters. Now let's talk about what's really happening with silver. Silver didn't suddenly become a headline because something magical happened overnight. It became a headline because a bold prediction collided with a volatile market. When Kiyosaki talks about $200 silver, the market doesn't hear certainty. It hears permission. Permission for expectations to rise, for positioning to expand, and for leverage to quietly build. Right now, silver is operating in that emotional zone where belief starts replacing balance. That's where markets become dangerous. Let's ground this before it runs away. Compared to yesterday, silver is holding firm after sharp moves. It isn't collapsing, but it isn't calm either. That combination should raise caution. Markets that move violently and then pause are not resting. They are deciding. Zoom out slightly. Compared to last year, silver is operating in a completely different regime. Last year was about discovery. This year is about digestion. Last year, silver was repricing higher. This year, it's dealing with the consequences of that repricing. Silver has already done the hard work. Now it's managing excess. And this is where big predictions become dangerous if they're misunderstood. Not because the number is impossible, but because timing is everything. Silver is not a straight escalator. It's a staircase with missing steps. Investors don't fall because the destination is wrong. They fall because they step forward when the floor isn't there. Kiyosaki's prediction works like gasoline poured onto an already warm engine. It increases speed, not stability. That's the warning. When silver runs too far too fast, belief replaces balance, and markets punish that shift. This year, volatility has expanded dramatically compared to last year. Daily ranges are wider, pullbacks are sharper, recoveries are faster. That tells us silver is under pressure, not losing relevance. Pressure isn't weakness, but it is dangerous. Think of silver like a pressure cooker without a clear release valve. As heat builds, the lid rattles. That rattling is exactly what market participants are seeing right now. The $200 call adds heat. It doesn't remove risk. The real problem isn't optimism, it's positioning. Many people hear a big number and assume time no longer matters. That holding through anything is the strategy. Silver does not reward that mindset. Silver rewards patience and punishes stubbornness. Compared to last year, leverage in silver markets is higher. Participation is broader. Expectations are louder. That combination creates fragility. Structure matters here. Silver is smaller than gold. Its liquidity is thinner. Its dual role as both a monetary and industrial metal makes it more reactive. When confidence rises, silver surges. When confidence cracks, silver drops harder than expected. This is why silver can feel like it betrays holders, even when the long-term story hasn't changed. But it isn't betrayal, it's mechanics. Kiyosaki's prediction should be treated like a weather forecast, not a calendar reminder. It tells you a storm may come. It does not tell you when the wind shifts. Right now, silver is not set up for smooth upside. It's set up for turbulence. That doesn't invalidate bullish scenarios, but it absolutely invalidates complacency. Compared to yesterday, silver is still tense. Compared to last year, silver is overheated. Compared to a decade ago, silver is operating in a completely different demand environment. All of those facts can exist at the same time. This is why warnings matter now. Not warnings of collapse, but warnings of misinterpretation. Silver can move much higher and still hurt people badly along the way. That's the trap. The mistake is assuming a bold prediction guarantees a straight path. Silver never moves in straight lines when expectations become crowded. And right now, expectations are crowded. Under the surface, the market is thinning. Liquidity steps back when volatility rises. That's when sudden drops happen. Not because value disappears, but because balance breaks. This is the environment where silver tests discipline. If someone is holding silver today, the most important question isn't whether $200 is possible. The question is whether they understand what silver does before it gets there. Because the journey is where most people lose conviction, capital, or both. This isn't a moment for blind confidence, it's a moment for awareness. That brings us to the next issue. If bold predictions raise expectations and volatility punishes poor positioning, what actually drives these sudden drops in silver? The answer isn't psychological, it's mechanical. Silver doesn't fall because belief disappears, it falls because leverage breaks. This is where most commentary fails. Unlike gold, silver futures require less capital per dollar of exposure. That attracts leveraged participation. Historically, silver moves 1.5 to 2 times faster than gold in both directions. That's not opinion. It's observable behavior across decades. When silver rallies sharply, margin usage rises. When margin usage rises, risk increases quietly. That silence is dangerous. One fact matters more than most people realize. The silver futures market is many times larger than annual physical production. That means most price discovery happens in paper markets first, not in vaults or factories. When volatility spikes or margin requirements increase, paper positions unwind fast. Physical demand doesn't disappear, but paper pressure overwhelms price in the short term. This is exactly why silver can drop hard even while industrial demand remains strong. Now connect that to today. Compared to last year, trading volumes are higher. Open interest expanded significantly during the rally phase. That confirms participation increased, not just price. More participants mean more leverage. More leverage means more fragility. This is where Kiyosaki's prediction intersects with reality. Influential upside targets attract speculative interest. Not all of it is reckless, but some of it is. That additional participation raises open interest and margin exposure. It does not add physical supply. Think of it like adding more cars onto a bridge without reinforcing the structure. The destination doesn't matter if the bridge can't handle the load. Silver's bridge is narrow. Another layer is supply. Global silver supply has been running below demand in recent years, driven largely by industrial usage. Solar, electronics, and electrification are not optional sectors. But supply deficits do not protect price from leverage-driven sell-offs. They shape the recovery afterward. This is where many investors confuse direction with timing. Silver can be structurally undersupplied and still experience violent drawdowns. Those drawdowns are not contradictions. They are how the market resets. Compare this year to last year again. Last year, silver's rise was gradual. Participation built slowly. This year, momentum accelerated quickly. That acceleration compresses time. When time compresses, reactions become sharper. That's why pullbacks now feel worse than last year's pullbacks. The market is carrying more tension. Silver hasn't broken. It's being tested. And tests are where discipline matters most. Another verified point that cannot be ignored is volatility itself. Measured volatility in silver has expanded significantly compared to the previous year. This is not subjective. Wider daily trading ranges confirm it clearly. High volatility environments reward patience and punish leverage. And this is where the warning becomes practical rather than theoretical. When someone hears a prediction like $200 silver and assumes volatility no longer matters, they fundamentally misunderstand how silver behaves. Silver does not trend smoothly when volatility is elevated. It whips. It overshoots. It snaps back. This is not an anomaly. This is its nature. That is why margin-driven selling often appears at the worst possible moment, right after optimism peaks. These sell-offs are not judgments on silver's long-term future. They are corrections of positioning. The market is not rejecting silver. It is rejecting excess. This is also why long-term holders and short-term traders experience silver very differently. Long-term holders think in years. The market trades in seconds. When those two perspectives collide, price action becomes violent. The disconnect between patience and immediacy is where most pain occurs. Another verified reality is liquidity distribution. Silver liquidity is not uniform across regions. Some markets hold significantly more deliverable metal than others. When stress hits, price reflects the weakest link, not the strongest. This is why silver behaves like a fault line. Pressure builds quietly beneath the surface, then shifts abruptly when a threshold is crossed. Bold predictions amplify this process. Expectations amplify positioning. Positioning amplifies risk. That chain reaction matters far more than the number itself. The warning is not that silver will fail. The warning is that silver will test those involved. Compared to yesterday, silver may appear stable. Compared to last year, it is far more reactive. Compared to a decade ago, it is operating under entirely different demand pressures. All of these realities can coexist. This is the environment where mistakes become expensive, not because silver is wrong, but because timing and structure matter more than conviction. This leads directly to the next critical issue. If leverage resets cause sharp drops, and if physical demand does not prevent volatility, what role does supply actually play during these phases? If leverage explains why silver falls quickly, supply explains why it does not stay down forever. This is where many people misunderstand the market. Supply stress does not stop volatility. It shapes what happens after it. Silver is not just a financial asset, it is a working metal. More than half of global silver demand comes from industrial use. This is a long-standing, verified fact reported consistently by the Silver Institute. Solar panels, electronics, electric vehicles, data infrastructure, these sectors do not pause because futures traders panic. They buy metal when they need it. That creates a floor, but not a smooth one. This is where the danger lies. People hear supply deficit and assume price should grind steadily higher. Silver does not behave that way. When supply is tight but liquidity is thin, price moves like water forced through a narrow pipe. Pressure builds behind it, then surges or drops suddenly when flow conditions change. This is why silver often looks weakest, right before it strengthens again. Now compare this year to last year. Last year, industrial demand was rising, but inventories were still cushioning the system. This year, that cushion is thinner. Global silver inventories are not collapsing, but they are uneven. Some regions are tight, others are relatively comfortable. That imbalance matters more than total supply numbers. Markets do not price totals, they price availability. When metal is sitting in the wrong place, price reacts violently to even small shifts in demand. This is one reason volatility remains elevated even after pullbacks. Another verified factor is mining supply. Silver mine production has not surged to meet rising demand. Most silver is produced as a byproduct of other metals like copper and zinc. That means silver supply does not respond quickly to higher prices. This point is critical. Even if silver rallies sharply, new supply does not immediately appear. That keeps long-term pressure intact, but it does not protect short-term holders from pain. Supply tightness behaves like a stretched rubber band. It stores energy. It does not control timing. Kiyosaki's prediction leans heavily on this long-term supply story, and that story is not fantasy. Where people get hurt is assuming supply guarantees near-term upside. It does not. It guarantees volatility. This is why silver's drops feel confusing to many. Tight supply is expected to act like a shield. Instead, it acts like tension. The tighter the system, the sharper the moves. Add another verified layer. Silver inventories in major trading hubs have shifted significantly over recent years. Metal has flowed toward regions offering higher premiums and stronger demand. That creates regional stress points. And when one hub tightens, price responds globally, even if other hubs still have metal. This is why silver behaves like a system with multiple weak joints. The entire structure does not need to fail. One stressed point is enough. This is also why silver often recovers faster than expected after sharp drops. Once forced selling exhausts itself, there is no equivalent force pushing price lower. Physical buyers step in, not emotionally, but practically. They do not chase highs. They wait for weakness. This distinction matters. A violent drop followed by stabilization does not mean danger has passed. It means the market is resetting. Resets take time. They often involve multiple swings. Silver rarely moves from excess straight into calm. It oscillates. This is why warnings matter right now. Not because silver is broken, but because silver is unstable. Unstable markets punish impatience. Compared to last year, silver is far less forgiving. Compared to yesterday, it may look quiet, but quiet in silver often precedes movement. Metaphors matter here. Silver right now is like a coiled spring under uneven load. Some pressure has been released, but not all of it. If someone leans on it without understanding where tension remains, it snaps. This is why predictions without context are dangerous. They focus on destination and ignore terrain. The long-term case for silver can remain intact, while the short-term experience is brutal. That is not a contradiction. That is silver. Which brings us to the most important question. If volatility is structural, leverage resets are unavoidable, and supply tightness keeps pressure alive, what should actually be watched now? At this stage, the most dangerous mistake is watching silver for answers it cannot give. Silver does not provide straight-line forecasts. It reveals where stress is building. That is what matters. If Kiyosaki's prediction did one thing, it highlighted how extreme expectations have become. Not wrong, extreme. Extreme expectations change behavior. Behavior changes risk. That is the real signal. Right now, silver is not deciding its final destination. It is deciding how much excess must be cleared first. This is why the next phase is not about price targets. It is about reactions. Watch how silver behaves on down days, not up days. Does selling accelerate immediately, or does it stall quickly? That distinction reveals whether forced selling remains active. Watch volume, not headlines. When price moves sharply but volume fades, exhaustion is near. When both rise together, instability persists. Watch recovery speed. In healthy but volatile markets, silver rebounds quickly after sharp drops. In unhealthy ones, it drifts lower slowly. Right now, rebounds exist, but they are uneven. That suggests the reset is incomplete. This is not bearish. It is unfinished. Also watch gold, but do not mirror it. Silver often diverges from gold during stress phases. Gold absorbs fear, silver amplifies it. If gold stabilizes while silver continues to swing, that is not weakness. That is silver behaving as it always has. Many holders misread this relationship. They assume silver must confirm gold. It does not. Silver leads emotionally and lags structurally. That is why its moves feel exaggerated. Another practical warning involves time. The most painful losses in silver usually come from impatience, not from being wrong. Entering too aggressively after rallies or exiting emotionally after drops both occur when expectations outrun structure. This is why bold predictions should be treated carefully. They are not roadmaps. They are stress tests. They reveal who is positioned rationally and who is chasing. Silver exposes that difference faster than almost any other asset. Right now, silver is testing discipline. Not belief, not conviction, discipline. If someone holds silver today, the most important skill is not forecasting. It is restraint. Knowing when not to act. Knowing when volatility is noise, not signal. This is where clarity cuts through the warning. Silver can still move much higher over time. Nothing in recent behavior disproves that. But silver does not reward certainty. It rewards preparation. This is not a market to fall asleep in. And it is not a market to panic in either. It is a market that demands awareness. The warning is simple. Silver is powerful, but it is sharp. Handle it like a tool, not a promise. Those who respect its mechanics survive its swings. Those who ignore them become part of the reset. That is the difference. And that is why the conversation around silver right now should not be about numbers alone. It should be about behavior, because behavior reveals more than any prediction ever will. Silver does not need hype to move. It moves when pressure builds. Predictions can be useful, but only if people understand the market they land in. Right now, silver is not calm, and calm is not guaranteed. The mistake is not believing silver can go higher. The mistake is assuming the path will be easy. Volatility is the signal. Discipline is the edge. If this helped bring clarity, make sure you're subscribed to its boring currency. Silver does not give second chances when it moves fast. Let us know where you're watching from, and we'll continue tracking what silver is really telling us before the crowd catches up.